If you're new to investing, it can seem overwhelming and complicated. There's a lot of industry jargon and terminology, and if you don't understand it, it might seem impossible. I'm here to tell you that it's actually not that complicated, and there's a couple of key concepts that you need to understand so that you can become a better and more confident investor. The first concept that I want to talk about is asset allocation. Asset allocation simply means the percent of your portfolio that's invested in stocks versus the percent of the portfolio that's invested in bonds. The reason that you care about this asset allocation has to do with risk. Stocks tend to be a more risky, more highly volatile investment, whereas bonds are more of a slow and steady investment with some guarantees of return at the end of the investment period. You can think of these two tools like the tortoise and the hare. Stocks are like your tortoise, kind of speeding along, helping you grow the portfolio. They can be up 5, 10, even 20% in a single year, but they can also be down by similar amounts. Whereas the bonds are more like your hare, slow and steady, maybe getting 2, 3, 4, 5% return on your bonds over time, depending on what interest rates are doing, but they're never going to get you 20% growth. And so it's by using these things together that you help manage the risk in your portfolio while also getting the growth that you're looking for from investing. So when you hear about asset allocation, you frequently hear things like the 60-40 portfolio. So what does that mean? Well, in that case, 60 is the 60% of your portfolio that's invested in stock, and 40% is invested in bonds. The first number in that ratio is always your stock side, and the second ratio is always your bond side. And the higher that stock percentage, the more risk there is in the portfolio. So a 90-10 portfolio, for example, would be a very aggressive portfolio, probably for someone who's just starting investing, maybe in their early 20s or 30s, versus someone who's in retirement, maybe more in a 50-50 portfolio, where they've got about half of their portfolio in stock and half of their portfolio in bonds to help bring that risk down. So when you start to determine what your allocation should be, you want to think about both short and long-term financial goals. So that could be things like retirement, sending your kids to college, or other major financial life decisions. And the longer your time horizon, the more risk that you can take. So for example, if you were telling me that you wanted to buy a house in 2 years, I would say that any money that you've set aside for that house purchase should be in very low to no risk. Maybe a little bit of bonds, mostly in cash, in a savings account, so that it is protected, because you just don't have a very long time horizon. On the other hand, if you have investments that you're saving for retirement and you're not retiring for 20 or 30 years, you have a lot more time for the market to grow and for you to wait through any periods of volatility. And so in that case, you could take more risk and have more stock in the portfolio to get that long-term growth. The other thing that you want to think about when you are determining your asset allocation is your personal risk tolerance. Every person feels differently about risk, and you have to take that into account when you're thinking about your asset allocation. If you're the kind of person who gets very nervous with investing and the market ups and downs, you may have a lower risk tolerance. On the other hand, if you have no problem getting sleep when the market's going up and down, then you probably have a higher risk tolerance and can be comfortable taking a little bit more risk with your portfolio. You should also be aware that if you're going through a major transition in your life because of a divorce or loss of a spouse, you may feel differently about risk than you did previously. You may have had a higher risk tolerance in the past, and now in this time of your life, you're feeling more conservative. That's perfectly normal and something that you should honor as you think about what you want your investment strategy to be going forward. With asset allocation, it's something that you want to monitor and revisit over time. So even if you set up your portfolio today as a 70% stock, 30% bond portfolio, you want to come back about twice a year and make sure that that's where it still is. As the market goes through its ups and downs, things will shift and move. And you'll want to make sure that you bring it back to what your target is so that you can have that right level of risk in your portfolio. You also want to make sure, again, that you're taking into account your personal risk tolerance based on any life changes that you may have had. And so does that still make sense for you as you go through time? So again, as you're thinking about starting to invest your portfolio, you'll really want to step back and think about asset allocation and make sure that you're taking into account both your time horizon and your risk tolerance when determining the right asset allocation for you. And of course, if you need any help with any of this, please don't hesitate to reach out. We're here to help you.